Welcome to the latest episode of Damien's Market Update. Now, this is the show where I talk about what's been going on in investment markets and what to look out for in the weeks and months ahead. Now, I've not done a show for 2 months, so I missed December's show because it was a very short month, leaving it to roll over into January. So we can now look back at what's happened in the last couple of months with markets. Now, in November, we witnessed a market rejuvenation. So it's the beginnings of it, which then accelerated. So after a disappointing October, the markets found their footing sparked by falling bond yields and a weakening US dollar. Now, that shift propelled the S&P 500 above key technical levels into a seasonally bullish period. Now, the initial surge in both bond and equity markets was followed by a period of consolidation. And that's as central banks reaffirmed their commitment to fighting inflation, which slightly dampened investors' optimism over the likelihood that interest rate cuts would come sooner rather than later. However, lower than expected inflation data back in November led to further drops in Treasury yields and the US dollar index, propelling the S&P 500 to its 2023 high. Over in the UK, the FTSE 250, buoyed by the prospect of rate cuts, enjoyed its best month in 3 years, and that highlighted the market's focus on macroeconomic indicators. Now, the strong performance of US tech stocks and the property sector, particularly in the UK, underscored the market's sensitivity to interest rate expectations, which paints a picture of a market tuned into the broader economic narrative. Now, moving into December, while traditionally that's the month that heralds the Santa rally, 2023 was something of an outlier depending on how you look at it. So based on the strict definition of the Santa rally, when an equity market rallies across the last 5 trading days of the year and the first 2 of the new year, we didn't actually get a Santa rally in the UK or the US. However, when considering the entire month, December showcased an extraordinary rally driven by rate cut expectations, which is shown by the table on screen at the moment, which looks at the December performance of lots of key equity market indices in their local currency terms. So you can see the Nasdaq 100 was up 5.51%. Then we had the all-world country index, the all-country world index, I should say, up 3.95%. And then you've got the European equity space was up around 3%, and then it moves down towards Asian equities up 2.76%. And then holding up the pack was the Nikkei 225, which was barely even. Now, this topped off a stunning year for most equity markets, especially technology stocks. So the next table you see actually shows you the performance of those same indices, but over the entirety of 2023. And you can see there's an eye-watering return for the Nasdaq 100, which is obviously very tech-heavy, of 53.81% during 2023. Japanese equities up 27.3%, and we had the S&P 500 up 24.23%, and you can see it goes down through European equities, which are broadly up around about 10%. Then you've got Asian equities up around 4.05%, and the laggard was the FTSE 100 at 3.78%. But overall, still a very good year for equity markets. But bond markets also finished the year strongly, with the average UK corporate bond fund up over 9% for the year. But nearly all of that profit actually came following the turnaround from that point in November. So the November low, when markets started to shift their interest rate expectations, that saw bond and equity markets rally strongly. Now, the performance numbers for December really hide a reality check that occurred for equity market investors as they headed into the new year. And that's because hawkish US central bank minutes and strong economic data challenged the rate cut expectations that the market had started to price in. So as a result, the 10-year US Treasury yield rose back above 4%, and global bond markets had their worst start to a new year since 2010. And that's based on the Bloomberg Global Aggregate Index. Now, this juxtaposition of a strong December rally against the backdrop of a turbulent start to January, possibly a bit of a hangover, set the stage for a market that was grappling with sort of mixed signals and heightened investor caution as we went into this new year period. Now, with the obsession over whether there would be a Santa rally or not behind us, investors' attention turned to another seasonal investment phenomenon. Now, at this time of the year, you'll often hear the old investment adage, as goes January, so goes the year. And there are different interpretations of that particular adage. One interpretation suggests that the first 5 trading days of January are statistically indicative of the overall trend for that year, while another version called the January Barometer looks at the full performance over the course of the whole of January, and that then gives you an indication whether you're going to have a strong year if you've had a strong January. And the idea of looking at the first 5 days, that's all we can do at the moment, because obviously we've not had the full month of January. But looking backwards, first of all, history tells us that on the 48 occasions where the market has been positive after the first 5 trading days, and I'm talking about the S&P 500 here, then there's been an 83% chance that the full year on the S&P 500 was also positive, and the average annual gain was in fact 14%. Now, the January effect actually occurred in 2023, and the S&P 500 was up 1.37% in those first 5 trading days, and we saw obviously the S&P 500 rally incredibly strongly during the year. If you recall the earlier numbers that I showed you, the S&P 500 was up 24.23% for the full year. Now, in 2024, the S&P 500 index didn't finish the first 5 trading days of the year in positive territory. It missed out by just 0.2%. But it must be pointed out that the historical evidence doesn't actually suggest automatically that if you miss that first 5 trading days, that it condemns the index to a poor year. But it did raise a few eyebrows nonetheless. However, since the New Year slump, equity markets have shown signs of resilience. Now, the Nikkei 225 broke above the key 33573 resistance line. So I'm talking about technical analysis here. And that is actually a 33-year high. And when it did that, the index then burst higher like a rocket and is up actually 6% year to date. Compare that to most other equity markets, which are mostly in negative territory. Now, you might think that move was something that was quite extraordinary, almost mind-boggling. If you look at the news, yes, you might think that. But if you look at technical analysis, then it is actually understandable. And when we did some technical analysis for 80/20 investor members back in November, this was flagged as a possibility. Now, while breaking out of a multi-decade high, or breaking through it, I should say, is impressive, what's more impressive is if you break through an all-time high. So for that, I want us to focus on the S&P 500 at the moment, because it's currently within a whisker of testing its own high, that all-time high of 4796.56 set on the 3rd of January 2022. At the moment, the S&P 500, as I make this video, is around 4,780. Of course, that makes 4,796 a strong line of resistance and a potential banana skin. But if the S&P 500 can close above that level and set a new all-time high, then that's a far better omen than any January barometer or adage. Now, if you go back to 2019, I carried out some research for 80/20 investor members, which looked at whether a new all-time high actually makes a stock market crash more likely. Now, the reality is that you are 55 times more likely to see another all-time high after a new all-time high before you see a 10% correction. Now, that of course doesn't mean that you can't get a correction, but the odds favour the market pushing higher if we do see a new all-time high on the S&P 500 very soon. So at the time when we see so many competing news headlines and investment themes out there that are causing markets to fluctuate, sometimes it helps just to focus on the objective rather than the subjective, and that tends to be technical analysis. So in summary, from mid-November to mid-January, where we are now, bond and equity markets have been on a bit of a journey of rejuvenation, cautious optimism, and then resilient rebounds as investors bet on central banks cutting interest rates and inflation abating. But after such a rebound, it does feel like we're at a fork in the road again, where equity markets could kick on to new highs or pull back. And which way will depend on a number of catalysts, and potential catalysts are likely to be economic data and what central banks decide to do when it comes to their rate decisions and monetary policy. But of course, just like 2023 in that earlier table when I talked about the different outcomes, the divergence in outcomes for different markets is likely to be a recurring theme into 2024. So that is it for this episode of Damien's Market Update. As ever, if you found that useful, do hit that like button, but also please do subscribe to the channel.